Oh boy, so the unemployment rate is going through the moon right now at a time that job postings are going down, and we have an interest rate cut on deck from the Fed. We're targeting 25 basis points of interest rate cuts, and unfortunately, many people are saying it's not going to be enough to save the economy. So, what could go wrong right now? Honestly, a lot. So, in this video, I'm going to break it down no BS, no fluff, no clickbait. If you stick around till the end, you're going to understand what's going on in the economy, what's going on in the stock market, and what does history say about what happens in the stock market pretty much every single time. We're going to go all the way back like 40 or even 50 years to say if the stock market's in the situation that it's in right now, how does it typically perform going forward? This is not me putting my twist on things. This is just me showing you the data of what's happening in the market right now and how we could capitalize. So here we go. All right, so let's head over to my newsletter that I just sent out. I send this out every Sunday, by the way, and if you want to get it 100% for free, the link is below. But I do want to start on the Fear Greed Index. So a lot of people are going to say, well, Brandon, the Fear Greed Index says it's 54 right now. Is that bad? And I'm going to say this. I understand that it's neutral. I understand that we're at 54. I understand that it was up here around 75. If we look at the chart, this just shows you the historical reading of the Fear Greed Index. I get it that we're coming down a little bit, but this is what I'm going to flip and say to you. Do you think that the stock market is cheap or expensive based on this fear greed index? For me, I'm going to say no, but for some people, they're basically just going to say the market's neutral, it's a great time to buy. And if you think like that, there's a lot of problems with that, and you're probably going to make a major mistake, which I'll cover in just a second. So, what I said here was if the market is fearful, there's potential opportunities and deals out there. So, extremely fearful, that is when I like to buy as an investor. I like to buy when things are on sale. And then, of course, when the market's greedy, that is potentially when things are overvalued. So now that we're in this neutral category, the market could kind of flip one way or the other. So we're going to come back to this chart. I just want you to understand that it's neutral, and there's so many people on X and YouTube right now saying the market is fine, the market's not a bubble, the market is actually cheap, a lot of people say. And by the end of this video, I think you're going to realize that this fear greed index should not, I repeat, should not be one of your key drivers for understanding the valuation level of the market. So I like to drop through the interest rates a little bit because interest rates are gravity on the stock market. You can see that the 30-year fixed rate mortgage is now down to 6.1%. 10-year bond is at roughly 4%, and a 2-year bond is roughly at 3.5%. And you guys are probably saying, well, Brandon, I get it. Like, I don't care about this stuff. And I'm going to tell you, trust me, you should care about this stuff because interest rates are gravity on the stock market. Everyone's going to say, oh my God, Jerome Powell, when he talks, the market goes up and down a lot. Well, what does he talk about? He talks about interest rates because interest rates are like gravity on the stock market. If interest rates go down, just like I said right here, as interest rate and bond yields go down, stocks usually become more attractive, which makes the risk-free bond look less attractive. So in English, all that really means is, do you want to put your money into a bond that yields 3%, or do you want to put your money into the stock market that's going to average roughly 10% in the long run per year? Most people are going to say the stock market. But if interest rates were to go up because maybe inflation goes up, then it's going to be more of a competition. You might say, well, maybe I'll put my money into the bond versus the stock. So there's this big debate right now of what investors want to do. Now, I'll tell you my thesis in just a second about interest rates, but interest rates are 100% critical. So let's dive into the meat and the bones of this right here. So we got some data this week that is basically confirming that the economy is slowing down and Jerome Powell is expected to try to go and save the world and save the economy. So if we head over to that chart, you're going to see that there's a 96% chance that we're going to get a 25 basis point interest rate cut. So that's just 0.25%, 1/4 cut. And that's going to be on September 17th of 2025. Again, nothing is guaranteed. This is just what the market is pricing in right now. So you're going to say, well, Brandon, interest rates are going to go down. Isn't that good for the stock market like you just said? And the answer is yes. But what if I flip this back on you and I say this? Do you think that that 25 basis point interest rate cut is already priced into the market? I mean, it's a 96% chance. Are investors pretty much assuming that that is a 100% chance that that is going to happen? Probably, because if we look at the chart, it's not that there's any chance of no interest rate cut because the current range is 4.25 to 4.5. There's actually a 3.6% chance that we get a 50 basis point interest rate cut, so a 0.5%. And you're probably wondering, like, why are we debating 25 or 50 basis points for the interest rate cut? And it's really going to come down to this chart right here. Let me get myself out of the way so you could actually see it. This is the U.S. unemployment rate. So you could see Over here in the beginning of 2025, we were at 4%, but now look at what we're at right now. We're at 4.3%. And this is freaking so many investors out because it's like right now in the labor market, there's not a lot of new jobs being posted, but there's also not a lot of people getting laid off. So that balance works right now. There's some people getting laid off, and then those some people are finding a job. But what happens if the labor market takes a crap and all these people happen to get laid off? Where are they going to go? How are they going to get a job? Because if there's simply not a lot of new jobs being posted, where are they going to go? And then we're going to roll into this chart right here that basically shows you US non-farm payrolls. And you could see 22,000 jobs for August of 2025. This is well below expectations, and you can see that June was actually negative 13,000 jobs. And of course, once this data comes out, I feel like it always gets revised lower. So there's actually a good chance that, this August data right here for 22,000 jobs, it's actually going to get reported down negative, which I'm sure Trump is going to throw a fit about it. But understand that non-farm payrolls are down, the unemployment rate is ticking up, and on top of that, the market is trading at historically high valuation levels right now. I know that we've talked about this chart before. Let me get myself all situated here. I know we talked about this before, and I know you're probably sick of me talking about it, but we do have to go through it. It just updated, and I have a really good analogy that's going to help you understand how the stock market is doing right now. Because I'm really just trying to help people. Like, there's so many people that post on X, post on YouTube, Instagram, TikTok, whatever, showing how much money they're making. And I'm going to be honest with you. I have a lot of investments that I set up months ago that I bought calls on, I sold puts on, I bought shares on, and I am printing money like crazy. Like, you wouldn't believe how much money my portfolio is going up because I capitalize on these companies that were super beat up in price and super cheap. But key thing, company, key thing here, this is the entire S&P 500 index. Let me zoom this out. So what I'm getting at is there are some deals out there still with individual companies, but the index as a whole, which is the S&P 500, which is the most common index that pretty much everybody references, it's expensive. Now, this chart goes all the way back to 1985. Obviously, it's 2025 right now. The red line corresponds to the S&P 500. The blue line corresponds to the price earnings ratio level of the S&P 500. Now, you're going to say, well, Brandon, why do I give a crap about the PE ratio? And I'm going to tell you this. Price earnings ratio, it's not everything. It's not even close to everything. But what I am saying is it's how much money you're paying for a company relative to their profits. So if you want to go buy any business in the world, if you want to go buy a car wash, you're going to say, how much am I going to pay for it? But on top of that, you're going to say, how much freaking money do you make? You're not going to say, what was your Fibonacci retracement? You're not going to say, what's your VWAP? What's your moving average? You're not going to say that stuff. What am I buying it for? And how much money do you actually make? Because if I buy it for $1 million and you make $100,000 a year in profit, I'll get my initial investment back in 10 years. But if you pay $1 million for it and you only profit $1,000 a year, it's going to take a long time to get your initial investment back. So this is kind of building on this chart right here. So going back to 1999, I just want to reference this period super quick. The valuation level of the S&P 500 was roughly 24, 25-ish for the PE ratio. You could see that the next 10 years going forward for the market, it honestly sucked pretty bad. Look at what we're trading at right now. Roughly 22, maybe 23 for the PE ratio. Again, it's a little bit high. And I do the analogy of this. Down here when the market's cheap, do we expect the future expected returns for the market to be good or bad? Most people and most economists and most people that really have a clue about how to evaluate the market and a company, historically speaking, when valuations are low, future expected returns are going to be high. Yes, there's a lot of volatility along the way right here, but geez, from 2010 to 2025, the market made a humongous move. The market went up a lot. But now that we're at this higher valuation level, it's like, how much higher can the price earnings ratio level go from what we're at right now? I'm going to say, really not that much. So then you're going to say, well, Brandon, what's going to push the market higher? And what is going to push the market higher is going to be earnings per share growth. But What happens if earnings per share growth slows down? What if the AI trade is blown out of proportion? What if the data centers are built? What if the chips are already made? What if the hyperscalers have everything that they need? There is a chance that the market's going to draw down quite a bit just because there's so much perfection priced into those stocks and so much perfection priced into the market that if it does not keep blowing the expectation out of the water, it's like this expectation versus reality thing. If you do not keep beating the expectation, the market will correct, and it usually will correct even more when the valuation level is on the higher side, which is kind of like what we're at right now. So I'm not saying the market is guaranteed to crash. I'm not saying it's guaranteed to fall. But what I am saying is, I'm very bullish on the economy and the stock market in the long term, like 10 years plus. I feel fine about the economy and the stock market. But in the short term, and of course, it's no surprise that Warren Buffett has so much money in cash and so much money in T-bills, T-bonds, T-notes. He's doing that because he simply can't find a deal somewhere else. So he's sitting in those liquid assets. When a deal pops up, like we just saw that Warren Buffett bought a little bit of United Health, and I get it, it was only a small percent of his portfolio. But when deals like that pop up, he has liquidity to sell the bond, go buy the stock, and then he's good. But if he doesn't find a deal, he's just going to sit there, collect his 4% yield, 3% yield, whatever he's getting, sitting there and waiting for a big opportunity. So Warren Buffett understands the S&P averages 10% per year. So then why is he sitting in this bond that's averaging 3% per year? He really thinks that the market is probably going to go down, or he just simply can't find deals in the market right now. Okay, so let's finish this up real quick. So what does this mean for us as investors? And again, this is my newsletter. If you want it for 100% free, links below, just check it out. It's pretty good. I send it out every Sunday. And sorry I haven't been posting as much content on YouTube. I've been sick the last week. It's been hard for me to talk, and I lost my voice and stuff. So I'm all right. I'll survive. But fixed income, as I was just building on with Warren Buffett, it's still attractive, but don't wait. So maybe you're older and you're looking into annuities and you want to lock in your rate. Check it out. Maybe you want to go buy bonds. The thing about bonds right now is if we think interest rates are going to go down, you're going to get less yield potentially depending on how you do it. But when yield goes down, the price of the bond is going to go up. And if the economy happens to take a big crap, Jerome Powell could cut interest rates pretty much overnight. And if interest rates go from 4.25 to just say 1%, which would be crazy, what does that do to the price of bonds? The price of bonds is going to go to the moon. So of course, that would be good if you hold some bonds, if that is your thesis and that's what you think is going to happen. So my portfolio, I'm a little bit heavier in bonds and fixed assets right now than what I typically am, and it has a lot to do with the economy and the market valuation. And there's a few other things that I see going on right now also. But again, everybody is a genius in a bull market. I'm telling you, you're going to get crushed if you think the stock market only goes up, especially at a time when the market is a little bit expensive. If you cannot sustain a 30, maybe even 40% stock market crash, you're going to get reset at zero. I could handle a 75% stock market crash right now. And if you can't, I'm not saying plan your portfolio to go down 75%, but what I am saying is the market has historically fallen 40% from peak to trough multiple times in the last, 20, 30, 40 years. So you have to be positioned to be able to survive through that. Because if you can't survive through the bear markets, you're never going to capitalize through the bull markets. All right, so let's go back to the newsletter real quick and wrap this up. So refinancing your home, it might make sense right now because interest rates were like 7% a year ago. Now they're roughly 6%. I like to refi if it's 1% or lower below what you're currently at. I do think rates are going to keep falling. So, maybe they do, maybe they don't. If you think they're going to keep falling, maybe hold off for a little bit and maybe you'll be able to snatch up a rate in the 5% range. We talked about how stocks are priced for perfection. And then the other thing that I want to talk about, which is honestly really fun to talk about, is IPOs, and they are coming in hot right now. So basically what's happening is there's IPOs and there's SPACs. And if you don't know what a SPAC is, it's essentially someone taking this pseudo company public, but there's really no company behind it. It's just basically raising money to go buy another company, which some people call these blank checks or whatever it may be. You're just trusting this investor or trusting this, whoever, this activist investor. You're going to give them your money. You have no clue what they're going to invest it in. You don't know what they're going to buy, how they're going to allocate it. You just simply don't know. But investors like to do this because when the market is hot and when there's euphoria with IPOs and SPACs, they know that they're going to raise the most amount of money in a time like that. So you have to be very, very careful in this market. This is proof that the best investors, the hedge funds, the institutional investors, They are bringing IPOs and SPACs, to the market right now because they know that retail traders are euphoric and retail traders are usually less savvy, and they know that they're probably going to raise more money than what they would have raised in April when the market was down for tariffs and stuff like that. All right, and to wrap this up, if you want me to do your all-in-one wealth management, you could read through this. I'm not going to stop the video for it. Definitely click the link below. You could hop on a free call with me and the team, and we'll go through your entire financial situation. But if you don't want to do that, check out this video right here. It's really going to help you out with investing. I'll see you guys there.